show. So at that time, you were saying that the bond market isn't going to wait for the Fed.
But the one story this year that wasn't the case last year is the mortgage spreads.
What are your expectations in terms of, do we approach those levels both on spreads and the 10-year? And what is the timeline?
Do we see a sub 6% mortgage rate in the last four months of the year?
You need jobs data to go lower. You need jobless claims to rise. Them cutting rates a quarter means absolutely nothing.
What's important for people out there to pay attention to that are in the market, that are trying to buy, sell, refinance?
This is the Educated HomeBuyer with Jeb Smith and Josh Lewis.
Logan, welcome back to the show. So last time we had you on, which was back in December of 2023, we actually had a 10-year under 4%. I think at that time, the day we filmed, is at 3.94%. The federal funds rate was at the same that it's at today. Since then, we've seen inflation moderate. We now have a 2 handle. We've seen employment start to ease a little bit. So I guess, and at that time, you were saying that the bond market isn't going to wait for the Fed. So I feel like that's a good place to start today's conversation, because there's a lot of people out there with the Fed's recent comment thinking that, hey, when the Fed comes out on September 18th and they make this statement that they're lowering by 25 or 50 or whatever the number is, that we're immediately going to see rates drop.
Yeah, that's kind of not how it works. The Fed follows the bond market lower. So just to give everyone a good example, the growth rate of inflation fell a lot in 2023, but the Fed still kept its hawkish stance. So like around a year ago was when the Fed actually gave a very hawkish take, and then the 10-year yield actually went up to about 5%. We had 8% mortgage rates, even with the growth rate of inflation falling noticeably, even faster than they want. So what's happened this year is that the labor data, I always tell people, I do paper, rock, scissors, labor over inflation. So the inflation growth rate is slowed down, but the labor data is finally slowing enough to get their attention. The bond market got ahead of the Federal Reserve. So we've already had a almost 2% move lower in rates from the peak of 2023 to the low point of this year. So I've always said, to get that next leg lower, you're going to need to see more labor and economic weakness, or a Fed becoming more dovish than they are currently. Because even if the Fed would have cut rates 3 times already, they're still restrictive based on their own policy, right? The growth rate of inflation falls. So they're a little bit late to this. But the one story this year that wasn't the case last year is the mortgage spreads are better. And just to give everyone an example, if we had the worst mortgage spreads from last year, mortgage rates are 0.5% to 60 basis points higher today. But since they've started to improve, which traditionally is the case when the Fed starts to get in its rate cut cycle, they still have a long way to get to normal. Mortgage rates can get lower by the spreads improving, which goes with the Fed rate cut. So the Fed rate cuts can affect the spreads improving, and that can bring low mortgage rates lower. If they are normal, it's 75 basis points to 1% lower in rates. So we're kind of in that unique stage of the cycle to where we're about to get the Fed rate cuts. And if the labor data gets softer, then the 10-year yield can go down, and then the spreads get better. You got very low 5% mortgage rates, even sub 5% if that happens. But again, the economic data still matters right now because we've already had a big move already.
In terms of the spreads, Logan, one of the things that I actually like to look at, because when they're generally measured and when they're quoted in the media, people look at the Freddie Mac survey, which only happens once a week and is 3 or 4 days out of date when it comes out. If you go into the Fred data, they now post Optimal Blue in there, and Optimal Blue publishes a 30-year index every day. So it kind of gives us a preview. They're going to move similarly. But that spread that you're talking about, I think Optimal Blue is down to like 2.4, and the last one on the Freddie Mac spread was just under 2.5. So it is absolutely trending in the right direction. Some really sharp people that follow this don't believe that we will get back to that 1.7-ish, plus or minus, whether it's 1.5, 2%. That 1.7 was pretty much an average over 20, 25 years. But because of changes and increases to guarantee fees, changes and increases to loan level price adjustments that Fannie and Freddie have done, do you have any feelings on where those spreads might finally shake out?
If we're going to use those metrics, historically, going back to the early 1970s, 1.8 to 2% has been the kind of the lower end range And just to give everyone an example, the reason why the spreads get worse is that when mortgage rates get higher, it's a risk to anybody in the industry that puts money into this, because that rate most likely is going to get refinanced at some point and they lose money. So if I give you like $10,000 for this rate and the rate's up here, and there's a highly likelihood that that can get refinanced, you're going to need a higher yield. So the spreads get worse on that. And then there's there's economic stress. Last year, the Silicon Valley banking crisis happened and the spreads went up higher. We can get down to kind of like that 1.8 to 2%. If you want to put the G fees into that, then maybe the 1.6 to 1.7. But every single time when the Fed starts to cut rates, and you don't need them purchasing mortgage-backed securities, but the spreads get better as rates come down lower. The increased ability of the lower rates to get refinanced gets less and less, and that's why the spreads typically get better when the Fed starts cutting. Now, there have been times in other decades where the spreads don't get bad at all, even during a recession. But in this case, the lower the rates go, the Fed's cutting, the spread should get better. If it gets down to 1.6 to 1.7, you could question that. But that's one of the reasons why the spreads have improved this year. A lot of people thought the spreads would get worse, especially as we get closer to a recession. But in this case, we've stayed elevated for a very, very long time. And the growth rate of inflation is falling and the rates are slowly moving down. Over time, that should improve. But again, that's just the spreads, the 10-year yield added onto it. It's the double whammy effect. That's how you get low 5% mortgage rates, and even sub 5% mortgage rates. If the labor market starts to break, the 10-year yield will get ahead of that. And you could easily get that. But that does require the economy to get weaker.
Got it. So if there's a tagline or a slogan that goes along with Logan, we're saying labor over inflation, right?
Yes, yeah. And so paper, rock, scissors, yeah, labor over inflation. And even though my fans understand it so much that they're sending me merch, labor over inflation.
Exactly. So today we got JOLTS, which is going to probably translate into PCE numbers on Friday. At the time this comes out, so actually this is going to come out after that data actually comes out. So you mentioned the 10 years going to move prior to some of these things actually taking place. So we've seen a pretty good move in the 10 year already. Do you think we're pricing in that movement ahead of what's going to come out on Friday into the spread already?
This is a very interesting topic because I've always said this 380 line on the 10 year is going to be a tough nut to crack. I call it the door, hold the door up. But if the labor market actually breaks and gets worse, you could actually get through this level. So we had negative revisions, growth rate of inflation falling in this 380 level. It's just going to be a tough nut to crack. I kind of said this in January of this year. But now, if we have a very bad jobs report, wage growth goes even lower, we miss estimates, unemployment rates, the 10-year yield will just smash that, because the bond traders want to get ahead of the Fed. The more they feel comfortable that the Fed is behind the curve, then they'll just go with it because they're here to make money. So the Fed follows the bond market. Now, twice now, the bond market has gotten way ahead of the Fed in 2022 and in 2023, thinking the economy was breaking. Both times it's been rejected up, but now it's different because now the Fed acknowledges the labor market's getting softer. So if you see authentic weakness in the labor data, the bond market can go lower off of that. And then the Fed has to play catch up at that stage because as an institution, they meet 6 to 8 weeks. So they're not, the bond market is a daily event. So that's why the jobs Friday will be critical. But also another key data line that happens every week, jobless claims. When jobless claims start to break toward 323,000, the cycle's over. That's traditionally what happens post World War II. So jobless claims, if you saw like a really, really weak number and it comes out every Thursday, the 10-year yield can move off of that. But we've priced in a lot of rate cuts already with the 2-year yield getting lower. But now, again, the Fed is still restrictive policy. That's kind of one of the things I've said. them cutting rates a quarter means absolutely nothing. They need to cut rates 6 to 8 times just to get to neutral. And that's neutral policy is basically, okay, we're not restrictive and we're not accommodative. So there's nothing in the discussion about a job loss recession in any of their talks, because they've even said this, well, if the labor market starts to get really weaker, then we can be more aggressive. Okay, so we're not at that stage. So there's a lot of downside that could happen, but it does, again, needs the labor market to get weaker for that to occur.
What are your thoughts on this? There's almost a paradox here in that we have borrowers. I have 3 borrowers right now in process, either on a refinance or a purchase, and they don't want to lock because of September 18th. And we've tried to explain and walk through it's not how it happens. The market is going to anticipate and move ahead of that. But we say the Fed is behind the curve. Part of the inflation problem is the Fed was behind the curve when they were way too accommodative for way too long. And now we're saying they're way too restrictive for too long. Is there maybe a paradox there that if they cut slower and less aggressively, that it actually leads to lower interest rates, that they cause more damage to the labor market inadvertently? So while people are saying, hey, I want to see a 50 basis point cut, maybe in the long run, a 25 basis point cut keeps them further behind the curve, further putting downward pressure on the market and giving us lower interest rates in the long run. Is that possible?
That's kind of been the Fed MO for decades. They're always late. They're, they on a few occasions they can get early, like in 2018, they started to cut rates before like the labor market was really deteriorating. So in this case, I would argue that they've on purpose kept everything restrictive until the labor market actually really deteriorates to the point that all of us can say, okay, now they're late to the game. And that's their cover, right? That's one of the things I've tried to talk about over the last 2 years. They really, really wanted the labor market to get so soft, and so that when they start cutting rates, they're going to go, hey, listen, this is our dual mandate. So if inflation doesn't get to 2%, we still have to care about the labor market, because we're probably not going to see core PCE get to 2% this year just because of the base effects. But in this case, as the labor market soft, they could cut rates. And again, if they cut rates 6 to 8 times, they're like neutral policy. That's not even an accommodative stance. So the longer they wait, the more of a chance that, you get a hard landing. And that's just generally kind of Fed in cycles, right? They tend to be lagging. The bond market, on the other hand, tries to get ahead of them, but the Fed, by its institutional, because they meet 6 to 8 weeks, is always going to be behind.
Now, you actually mentioned this in the Housingwire podcast. Now, if you guys are listening to us and you don't listen to the Housingwire podcast, you should. Logan speaks 2 times a week, and it's really good information to keep you updated. Doesn't matter if you're a buyer, seller, real estate, mortgage professional. It's really good information. But in there, what I will say is you've kind of addressed this question, but maybe a lot of our audience hasn't heard the answer to this. So a lot of our watchers seem to believe that, the drop in mortgage rates isn't actually helping housing. Can you talk about that a little bit? Because, there's this misbelief that because everything is slowing down, that this jump in rates hasn't even had an effect yet.
So one of the things we do, our podcast is a top 10 business podcast because our information is fresh. Our tracker information that we provide every single weekend is designed to give everyone the freshest data, so you don't wait for home sale reports that are months behind. So one of the part of the tracker is that we track purchase application data, but we also tagline it to the points to where rates fall or rates rise. So this entire year, it has been a negative trending data line, except for the last 13 weeks. So as mortgage rates started to fall for the first time, the last 13 weeks, we've had 8 positive prints versus 5 negative prints. So on the weekly data. So that's a material change. I don't think people are trained to read the purchase application data because it's something fairly new to them. It's just a trend survey. The new home sales market has had a big beat, in their last reports because rates went lower. Their purchase application data has done better than the existing home. So lower rates have already impacted the forward-looking demand. It's also actually slowed the inventory growth down to the point to where we had our first negative week-to-week print. So unless you track or listen to someone who's actually done this for a very long time, they would miss this. And this is something I even talked about in the last tracker articles, that I just don't think people are accounting that, okay, we were negative up until rates started to fall in June, and now the data's gone better. Because we've gone from a negative to a positive curve, lower rates have kind of done their thing. Now, it's also a very seasonal data line. Usually I only wait it after the second week of January to the first week of May. After May, volumes tend to always fall, just because it's the spring and summer buying pattern. Like all housing data, it's very seasonal. So the fact that we're not getting any kind of big volume is not shocking at all, because that happens every single year. But we do see a positive curve, not just for existing, but also for new home sales as well. So we're not growing it in a very big fashion. This isn't like the COVID-19 V-shaped recovery that we saw, but just today, being down 4% year over year is the smallest year over year decline in purchase application going all the way back to 2022. So it's because we have a very low bar, but there has been a material change in the data line.
And from that perspective, I can say that refinance volume is up massively. When it's up massively from a very, very low level, it doesn't look big. There's not a flood of refinance volume.
Yeah, it's one of those crazy data lines where, I always make fun of the foreclosure people because they go, foreclosures are up 700%, it's like the lowest space ever. So the refinance index is up 94% year over year. It's working from the lowest levels ever. So yeah, so sometimes I always caution people, be careful of percentages when you're working from the lowest levels ever, because you can get a really big percentage, like, wow, you think about it, and then it's like very small out there. So yeah, that does happen for a lot of, just in general, a lot of economic data lines, you have to be careful of weighting percentages when you're working from extreme low levels.
One of the most valuable things that you do, and which I think is different than a lot of analysts, is you have your models that you work with of where you expect things to go. Now, we've talked about the spreads and hopefully moderating to 2, possibly lower than 2. Talked about the 10-year. You had talked about your new line here at 380, which 380 has held really strong here, really strong over the last month or two. We still have your Gandalf line at 325. And if we got all the way to that 325 and we got to a 2 spread, that's a 5.25 rate, which is about a full percent below where we're at. When you're modeling it out, what are your expectations in terms of, do we approach those levels both on spreads and the 10-year? And what is the timeline? Because it feels like in the current market, the bond market has been a little bit chastised by getting ahead of themselves twice, and they're going a little bit more deliberately this time than they did last fall.
Well, the labor market is deteriorating to the point to where I always tell people, follow kind of residential construction workers and manufacturing workers. They tend to fall before every single recession, which this hasn't been the case the last. So like all these recession calls were missing that. And I realized what happened. Not a lot of people actually know that. It's usually residential and manufacturing and industrial production falls. These are kind of the last stages. But if you actually take the deterioration, you're looking at probably within the middle part of 2025 to where you noticeably will see an increase into the unemployment rate to get up toward kind of 4.6 to 4.9%, just because if we're not creating 250 to 300,000 jobs, the unemployment rate could actually rise here because the run rate is higher. So that's kind of how we look at it. The thing is that what's different now than the last 2 years, and this was really key for the cycle, multifamily permits are at recession lows back to COVID. Single family permits have been falling for months. Housing starts are at recession lows. Permits are at recession lows. But the big workforce in the residential is remodeling. And Home Depot and Lowe's have both warned that that's slowing down. I'm just trusting that the Fed staffers, who I usually make fun of because I know they listen, that every single economic cycle, when that happens, that's not good for the labor market. That's the deterioration. So everyone's keeping a close eye on that. Now, the last new home sales was a big beat. Lower rates have helped out. Big builders still have profit margins they could use to sell homes. So that's kind of the tug of war. Has this lower rate move already changed the dynamics to get single family permits to go again? But to really take this to the next level, you're going to need jobless claims to break up higher. You need the jobs reports to have multiple sub 100,000 reports or gains there. And then if it goes negative, you can get the 10-year yield down to 2.72. That's sub 5% mortgage rates. You got 4 handles there. The spreads would actually be better. And the Fed itself would have to change from Okay, we want to go to neutral. We're going to take our time to neutral. Okay, we have to get to a not a neutral stance, but an accommodative stance. See, we're not having that discussion now because the labor market is not broken yet. But once it breaks, everything flips very fast. So the language would change. So I'm keeping an eye on the residential side because unlike the last 2 years, we actually have all three levels showing weakness. And at this stage of a game, it's like you're playing with fire when you don't need to. So hopefully the Fed starts to get a little bit more creative in their language and tells the bond market, hey, it's go ahead. It's okay. Take it down there. Take it down there. Because the Fed really needs housing back for that not to happen. If they truly don't want the labor market to break, that's the key data line. That's the key sector to follow.
So kind of on that same topic, housing has more or less been in a recession for the last couple of years with the number of transactions, the number of sales actually taking place. 4 million, kind of that number. We've been stuck there for 2023. It looks like 2024 is probably going to come in somewhere around 4 million on the existing home sales. What are your thoughts with lower rates? Because of affordability? Affordability is still an issue out there in the market. And I realize, you don't do forecasts, you don't do predictions, that sort of thing. You look at your model. But when looking at your model, looking at lower rates, number of transactions, what do you think takes place? Because
you can grow. Now, see, the existing home sales market has been in recession since June 16th, 2022, 5:31 p.m. I remember these dates like crazy. But it's really rare after 1996 to get home sales below 4 million, just because we have 162 million people working and not everyone is hit with an affordability crisis. However, the new home sales market still has residential workers. They haven't laid off anybody yet. That's because there's a whole interesting dynamic with construction labor backlog. Builders are paying rates out. But the builders, though, their purchase application data has been rising for years. Their home sales have bottomed in 2022. A sub 6% mortgage market grows sales for them. A sub 6% mortgage market can grow sales for the existing home sales market, even just because you're working from the lowest levels ever. So that's how I'm looking at it. But you need that marketplace to get there, right? The low level of my forecast for 2024 was 5.75 to 6.25. So we're kind of almost there. But you get a sub 6% mortgage market and it stays there. See, here's a really good example. People tell me, well, affordability is the worst ever. Not necessarily. It was actually worse in the early 1980s. But what happened in the early 1980s, there's some similarities. Back then, we had more inventory. We had a recession. Home prices didn't fall back then in the early 1980s, even with 16 to 18% mortgage rates. But when mortgage rates went 2.5% lower and stayed there, even back then, it grew sales noticeably, right? Just because you're working from the low level. So I've been in the camp that you need sub 6% mortgage rates and you need it to stay there and not go up. See, every time we have rates go lower, we get a little bit better demand and then rates shoot right back up and kills it off. So you need it like every other cycle we've had after 1981, where you get 2% plus lower mortgage rates and it sits there and it stays there. And then you could grow sales, especially now when you're working from to me, it's adjusting to the workforce, the lowest levels of sales ever. So it doesn't take much to move the needle, but you do need that sub 6% mortgage rate because that has appeared to work for the builders since the bottom of 2022.
So, all right, Josh, I'm going to jump in real quick here. So tagging off that, Logan, do we see a sub 6% mortgage rate in the last four months of the year?
You need the labor market to break. I mean, you need jobs data to go lower. You need jobless claims to rise, and that can get you to my low end forecast of 5.75 to 6.25. So that's why this 380 level for me is key. This is why these job reports are more key now than in the past, because the Fed has finally acknowledged all the labor data that they track, that they've told us to track, is now getting noticeably weaker. The history says you get to that next stage, and the history says you keep an eye on housing data more than ever right now. And all the housing data, permits are falling, starts are falling, remodeling companies are warning. That can take you down there. So we only have a few months left in, but you can get to that low end range of my forecast, which is 5.75 to 6.25 this year. But if you really, really want to grow sales, you got to get in that sub 6%. You got to have rates stay there for the entire year. And then everybody, because everybody has to plan their housing purchase. It's not like you all of a sudden get up and just go there. All right, let's go buy a house right now. lower rates for longer. People can make plans and not worry about rates jumping on you again. That whole 2023 8% move was crazy. There was no need for that, right? The growth rate of inflation has been falling. It's crazy to think this. We had lower mortgage rates with like hotter inflation on a year-over-year basis. But now we can get to that next stage, and that does require either the Fed becoming more dovish, the spreads getting better, or the labor data. Those are the three things that could get you to the sub. We're not that far off from it right now. So, but at this stage, those three variables are your key if you're still looking for that in 2024.
Well, that's what I was going to ask is maybe quantifying what that looks like. We have an expectation. So Friday, we get the jobs report. Unemployment per last month was at 4.3. It's projected to be at 4.2, but it was also expected to be flat or improve slightly last month, and it got worse. We have the weekly claims on Thursday, and those are probably the two most important ones. And we've been seeing about 240,000 claims. So are those the important numbers that someone would be looking at the weekly claims and the unemployment rate, or is it the actual jobs created in the monthly report?
Oh, in the jobs report, there's a few things to keep an eye on that the Fed really tracks. Wage growth. The Fed has this model that they're using, and wage growth getting down to 3% is kind of like their goal. We're not that far off from that. We're like 3.6%. But the headline numbers, if you get any misses, the unemployment rate's going to keep on rising. That just puts more pressure on them. Right. So even if you created 130,000 jobs, you're not losing jobs, but the unemployment rate can go up. Jobless claims every Thursday is the key, because if that data line starts to go up, then the Fed is behind the curve. Jerome Powell said this a few months ago. That was the first time he came out in public, says, hey, we follow jobless claims and it's been falling for months. It's not falling for months anymore. It's been rising from its base. So jobless claims to me runs everything. If that thing starts to break toward 323,000, they're cooked. Their soft landing kind of goes away. So don't put all of the eggs in every one jobs report. Always follow the trend, and the trend has been going down for many months now, and the job opening is just another example of it. So softening but not breaking. Breaking means jobless claims rise, construction workers lose their jobs, manufacturing, and it looks like every recession we've had post-World War II.
Got it. So Logan, we've kind of we've been on the same page for the last 4 years with regards to housing data and what's going on with COVID and what we expect the market to do and what have you. You've been somebody out there pretty loud with your opinion on the trolls, the people out there talking about foreclosures, talking about all the craziness in the market, what was going to happen that didn't happen. So I guess advice for people that are buying, selling, maybe not immediately, just in general. The average consumer doesn't follow data like you do. We follow it, and we don't follow it like you do, right? So you are deep into the numbers. What's important for people out there to pay attention to that are in the market, that are trying to buy, sell, refinance, whatever it is, with related to housing?
So I think what a lot of people don't know is that if I take home price data going from 1942 all the way to today, there was only one period of time in history where home prices crashed. That was 2007 to 2011. Really, we only had one negative year. If I take that out, it was like in the early 1990s, we were down 1%. So if you're looking for housing, always think of this. Housing is the cost of shelter to your own capacity to own the debt. You got to find that total principal, interest, and taxes. And that's your fixed debt cost, right? The reason why millions and millions of people buy homes every year, even in 2023 and 2024, is that they have the ability to take that fixed debt cost. And then the reason why the U.S. has an advantage, why the world hates us, is that your wages rise every single year. So we don't have a lot of history of home prices falling in a big manner, but because your wages rise, your debt cost stays the same, and your house costs on that. Now, your property taxes and insurance can go up, of course, but this is why millions of people buy homes, just for that one principle. The 30-year fixed loan is this gift that other countries hate us for. This is why homeowners on paper are not only wealthier, but their cash flows are better. Always look at housing, and that's because people always tell me, how do you get 5 million home sales last year and this year? Well, what are people thinking? Well, they're buying a home to live in. That's what they do. That's what people do. They rent, date, mate, get married, 3.5 years after marriage, have kids. They buy a home and they stay there for a long time. They don't think of housing like the kind of the doomers do, where, oh my God, if your home price went down 2%, they're just living in their home. So the cost of shelter is always the key. And because of qualified mortgage, you can't really go over the limit. You literally have to qualify with it. And what occurs is that over time, your wages grow and your cash flow gets better for that. There's all these other costs with housing, of course, and then, car payments, stuff like that. But this is why people buy their homes. They buy their homes to live it. And even with the worst affordability since the early 1980s, even with home prices escalating 6 to 8%, we still have near 5 million total home sales. Those are the legit buyers that have been here post World War II. So when you think of housing, think of cost of shelter. If you're worried, I always tell people, if somebody asks me if they should buy a home, I always tell them, no, you're not ready. There's a young lady in Ohio that just bought her house. She's ready. There's somebody in Florida that just bought their house. They're ready. You should not have any issues with the total payment that you have right now. And that's the only thing you go to bed with every night, wake up in the morning, you take your kids to school. It's the cost of shelter. And that explains housing economics post-World War II and why millions and millions of people buy homes every single year. It's just a shelter cost. And if you get caught into the noise and all that stuff, it's never going to make sense to you. Just think of it as shelter costs, and then you just go on with your life, go to work, do all the stuff that you normally do. And that's how people have operated with housing economics for many decades.
Yeah, it's funny looking at the channels out there that pander to the people that need home prices to crash to be able to afford. I think most of the people are actually pretty smart. It's tempting to say they're dumb, but they're smart enough to pervert the data and actually talk about things like mean reversion. Well, mean reversion doesn't apply to levels. It applies to ratios. And you said something really important. It's the ratio of household income to that payment. And it is elevated, and it will likely revert, but it doesn't have to revert with a crash. And it hasn't, except for, like you said, the random time, not random, a purposeful time in 2007 when things had gotten way out of whack.
I would tell you this. The housing crash addicts are mostly all anti-central bank people. And my advice to everyone is that, because I challenge these people to live debates, you do not listen to a single housing person or analyst that says they're economists unless you read their forecasts. Right? And you have to have, I always tell people, can I read your forecast in 2024? It's funny because I'm still asking for the housing crash people, their 2024 forecasts. I've got nothing. So every single day on social media, I keep on challenging people to live debates, because what I'm going to do is I'm going to get your last 5 years of your price forecast. They're going to be terrible if they did it. They never give me any of it. I'm going to get your year-to-date forecast, and then I'm going to get your model. If somebody cannot provide you this, they are not an expert. So all the housing crash people for years, like I've documented, this is year 13 now. I've been doing this for so long. Every year they have something. They've been so wrong for so long that it just devoids from reality. However, doom porn sells. It is effective, right? You get all these crazy headlines where the Great Depression 2.0, home prices are going to fall 70%, whatever. They draw the people in. But I would say that if you're authentically looking for people that actually, it's the professionals, and all you have to do is ask them for the forecast. And I guarantee you, you will get zero, right? Because if they actually had to forecast and show a model, their whole grift is done, right? So this is one of the things that for 2024 has been fun for me. I just go, can I read your forecast? Nothing. Can I read your forecast for the last 5 years? Nothing. Can I see your economic model? Nothing. Right? So they make up a bunch of stuff. Because they make up a bunch of stuff and they don't show you the forecast, none of it has actually worked. I mean, this year is a really good example. Like early on in the year, my price growth forecast was going to be off. I was too low. Now that rates had gone up earlier in the year, there's a good chance that I could be more right. But that's a model. That's something that works. That's something that history. And I realized this year, not a lot of people knew that since 1942, it's really rare for nominal home prices to fall. If you take the 2007 to 2011 period out of there, it only happened one time, right? And there's a reason for that. Most sellers are buyers, right? Unless you get stressed sellers into the data line, it's really rare to have like your home prices fall in that nature. You have places like in Austin that are down 20%, but Austin also went up 76% in 2.5 years. Mortgage rates jumped up. It's not because distressed sellers or anything. It's just the affordability. So again, they own that Red Sea of doom porn out there, but if economics is done right, it's actually should be boring. It's not really designed to be this fun, hot, sexy thing. I try to make it as entertaining as possible. But again, I do it with data and models, and that's how it should work. And it explains what's happening in 2024. It explains why the growth rate of inventory has slowed down now as mortgage rates go lower. Everything connects the dots. And if you really cared about following like insightful information, that's where you go. But I just think a lot of people like doom porn. So it is what it is. It's the world we live in.
Well, we appreciate you keeping it entertaining. For those out there listening, you want to follow Logan. He's on social. A lot of the stuff that he talks about here, he talks about on Instagram and TikTok or Twitter, rather, X, whatever you want to call it. So he's posting this information daily to keep you up to date. So if you want to follow him there, check him out on Housingwire as well. But we want to be considerate of your time, Logan. We appreciate you coming on again, giving viewers, listeners what they need to know in order to make, good decisions, informed decisions rather. So thanks again, guys. We'll be back next week. But until then, buy right, borrow smart, build wealth. Adios.
Thank you. Pleasure's all mine.